Today, we'll be continuing on with Chapter 6, starting with Part B, Recording Inventory Transactions. We've talked about purchases and sales of inventories and how to track their costs. We have not yet discussed how to actually record inventory transactions. So let's take a look at that now. LO 65, Record Inventory Transactions using a Perpetual Inventory System. To maintain a record of inventory transactions, most companies use what's called a perpetual inventory system. This system involves recording inventory purchases and sales on a continual basis. Helps the company better know the inventory levels and manage them, and like I said, it's most often used. So think about when you go shopping at, say, Old Navy, and you find the shirt that you really like, but they don't have it in your size. You go and ask an associate if they have that shirt in your size. What do? They go to their computer and look it up to see. That is an example of a perpetual inventory system. Every purchase and every sale is recorded in the computer, so they're able to continuously see how many items they have on hand. In contrast, a periodic inventory system does not maintain a continual record of inventory. Instead, it calculates the balance of inventory once per period at the end based on a physical count of inventory on hand. It's not very useful, doesn't keep the systems up to date, and most companies don't use it today, especially now with the use of computers. Therefore, in this section, we will focus on how to record inventory transactions using a perpetual inventory system. So looking back at Mario's game shop, we remember that Mario had beginning inventory, and then he had 2 sales and 2 purchases. This time we're going to put things in date of the order in which they happened. So he had a beginning inventory on January 1st, totaling $700. Then he made a purchase on April 25th for 300 units for a cost of $2,700. Then on July 17th, he sold 300 units for $15 each. On October 19th, he purchased 600 additional units for $11 each. And then on December 15th, he sold 500 units for $15 each. We're going to take a look at these transactions now using the perpetual inventory system. So this is going to be just a reminder, a refresher of things we've covered before. On April 25th, Mario purchases inventory for $2,700 on account, 300 units at $9 each. So what are the 2 accounts that we need to use to record this transaction? Well, we know on account means he did not pay cash for it. So he owes the company money. So on account is going to be an account payable. Do we debit or credit the account payable? Well, it's increasing, and we know that account payable is a liability. Therefore, we will credit it. In addition, inventory is a current asset and it's increasing, so we will debit inventory. That is how you record the purchase of inventory on account. Now, on July 17th, Mario sold inventory on account for $4,500. In order to record this transaction, we need to record 2 entries. The first entry will record the actual sale of the assets. It will record an increase to an asset account and an increase to a revenue account. So let's look at it. He sold the inventory on account. Therefore, he did not receive cash. They owe him money. He will receive the money later. So he will record an account receivable for $4,500. He also sold the inventory, so he's able to recognize the revenue of $4,500. That's the first half of recording the inventory sale. The second entry, we need to reduce our inventory because we no longer have those units on hand. So how much do those units cost us? Well, we have to use one of the inventory cost methods that we've previously discussed. In this example, we're going to use FIFO. So we're going to record a cost of goods sold, which is the expense, and reduce inventory by the same amount. How did we get the $2,500? Well, we're using FIFO, first in, first out. He sold 300 units. So if we go back, we look and we say first in, first out. He sold 300 units. So he sold all of the beginning inventory that cost $700, and then he sold 200 from the April 25th purchase that cost $9. So 100 units at $7 and 200 units at $9 equals our $2,500 cost of goods sold. Next transaction. October 19th, he purchased inventory for $6,600 on account. Those 600 units at $11 each. What would be our journal entry to record the inventory purchase on account? Right. Inventory is increasing, so we need to debit it by $6,600. And accounts payable for $6,600 credit. We owe them money, so it's an account payable. On December 15th, Mario sold inventory on account for $7,500. He sold 500 units at $15 each. So the first step is to record the sale. He sold them on account. He did not get cash, but he will receive the cash later. Therefore, he records an account receivable for $7,500 and sales revenue for $7,500, the 500 units at the $15 price. Second step is to record cost of goods sold and inventory. Record the expense of the inventory sold and decrease your inventory. So he sold 500 units. Using a FIFO method, we say that he sold 100 units at $9. That is the 100 units that are left from the remaining purchase on April 25th, plus 400 units at $11 each cost from the October 19th purchase. Total of those equals the $5,300. So let's take a look at his T account. Remember, T accounts are so important. He had his beginning inventory balance of $700. His two purchases gave him total inventory available for sale of $10,000. Then he had the two sales on July 17th and December 15th for a total of $7,800. So what is his ending inventory balance? $2,200. Debit. That is his ending FIFO balance. LIFO adjustment. As we know, some companies prefer to use the LIFO basis for preparing financial statements. So to convert from a FIFO basis to a LIFO basis, we have to do an adjustment. The difference in reported inventory when using LIFO instead of FIFO is called the LIFO reserve. So remember, Mario's ending inventory when he was using FIFO was $2,200. We just saw that in the previous slide with the T account, but it's the 200 units from the 10-9 purchase at an $11 cost is his ending inventory under FIFO. It's really easy to determine his LIFO adjustment because we would just look back and see what his ending inventory would have been had he used the LIFO method. If he had used the LIFO method, ending inventory would have been $1,600. It would have been 100 units from the 425 purchase at a $9 cost, plus 100 units from beginning inventory at the $7 cost. Remember, with LIFO, you're starting at the bottom and working your way up as you sell them. So your ending inventory consists of your oldest items, which would be your beginning inventory and the 425 purchase. So how do we adjust from the FIFO ending basis of 22 to the LIFO ending of 16? This is the T account that we already saw with the transactions recorded with the December FIFO amount of $2,200. We just calculated that LIFO needs to be 16. So what would we need to record in our inventory count to get inventory from 22 down to 16? We would need to credit inventory by $600. That is our LIFO adjustment. The journal entry to do this would be that credit to inventory and then debit cost of goods sold for $600.